Here's something that sounds impossible. Two mines can sit on the exact same amount of gold, in the exact same ground, and one of them can be a phenomenal investment while the other quietly goes bankrupt. Same metal, same earth, completely different outcomes. If you think owning a gold mine is simply about how much gold is buried underground, you're missing almost the entire business. A gold mine isn't really a mining business. It's closer to a leveraged financial instrument wrapped in rock, sensitive to currency swings, interest rates, geopolitics, and a countdown clock that starts the moment you begin digging. Today we're breaking down what actually determines whether a gold mine makes you rich or wipes you out, and why gold mining companies behave less like industrial businesses and more like a leveraged bet on the entire global economy. Let's start with the idea that reframes everything else in this video. A gold mine is really an option on the gold price, not a straightforward production business. A mine can look mediocre at one gold price and highly profitable at a different one, because the entire value of the ore body shifts with the market. The asset isn't really about what it's producing today. It's about future price optionality, what that same ore body becomes worth if gold prices move. This is the single biggest thing separating a gold mine from owning gold itself. Bullion is a static store of value. A mine is a leveraged bet layered on top of that value, one that can swing wildly in either direction depending on where gold prices go next. Here's the mistake that catches even experienced investors: assuming a gold-rich deposit automatically means a good investment. It doesn't. A mine can contain genuinely valuable gold and still fail as a business if the ore grade is too low, if the amount of waste rock that must be removed per ounce of gold, the stripping ratio, is too high, or if the location is too remote to operate economically. The geology can be spectacular while the actual economics remain weak. In other words, how much gold is down there matters far less than how expensive and difficult it is to actually get that gold out, processed, and sold. Rich rock and a rich business are not the same claim. Here's a stage of this business almost nobody outside the industry thinks about: exploration. Before a mine ever produces $1 of revenue, owners typically spend heavily on geology, drilling, testing, and permitting, often for years. Many of these projects die before they ever reach production, which means, in a very real sense, the gold mining business isn't purely a mining business. It's part mining and part high-stakes capital allocation, where a huge share of projects never make it to the finish line at all. This is closer to venture capital wearing a hard hat than most people realize. You're funding years of exploratory spending on the chance that what you find is economically viable, knowing full well most exploration projects never become a working mine. Here's a distinction that separates people who understand mining economics from people who don't: the difference between headline extraction cost and what's called all-in sustaining cost. The cost per ounce that serious investors actually care about isn't simply what it takes to pull gold out of the ground. It also includes sustaining capital investment, processing costs, overhead, and regulatory compliance. This is exactly why some mines that look cheap on a surface-level cost basis are, once you include everything, not actually cheap at all. A mine can look brilliant on a simplified spreadsheet and mediocre once every real cost is accounted for. Serious mining investors don't look at extraction cost alone. They look at the all-in number, because that's the number that determines whether the business actually survives a downturn in gold prices. Here's where gold mining connects directly to global macro forces, and this fact genuinely surprises most people. Gold is priced globally in US dollars, but many mining operating costs, especially labor and local supplies, are paid in local currencies, which means if the local currency where a mine operates weakens against the dollar, that mine's costs can actually fall in dollar terms, even if absolutely nothing changes operationally on site. This is a wild dynamic. A mining company's profitability can improve purely because of a currency crisis happening in the country where they operate, completely disconnected from how well the mine itself is actually being run. Gold mining margins are quietly exposed to currency markets in a way most investors never consider. This is the fact that ties gold mining most directly to everything else this channel covers. Ownership risk depends enormously on where the mine is located. Taxes, royalty structures, fears of nationalization, sanctions, and sudden permit changes can matter just as much as ore quality, sometimes more. A world-class deposit in a politically unstable country can be worth dramatically less than a mediocre deposit in a stable, predictable jurisdiction, purely because of the risk that a government decision could strip away the economics overnight. You're never just buying rock and gold when you buy a mine. You're buying exposure to a specific country's politics, tax policy, and relationship with foreign capital, for as long as that mine keeps operating. Here's a structural feature of this business. Unlike almost any other industry we've covered on this channel, a mine is a wasting asset. Unlike a factory, which can theoretically run indefinitely with maintenance and reinvestment, every single ounce a mine extracts permanently reduces its remaining resource base. There is a finite amount of gold in the ground, and every day of production brings the mine closer to depletion. Which means owners aren't just running today's mine, they're locked in a constant race to replace reserves through further exploration or acquisition, just to keep the business alive past the current deposit's lifespan. Standing still isn't actually standing still in this industry. It's slowly running out the clock. Here's a counterintuitive fact that overturns how most people imagine the best gold mine. Infrastructure can matter almost as much as what's actually in the ground. A lower-grade mine sitting near reliable power, roads, available labor, and stable regulation can genuinely outperform a richer deposit stuck in a remote or unstable region. The gold might be more concentrated in the exciting, hard-to-reach location, but if it costs a fortune just to get equipment, people, and power there, that richer deposit can end up being the worse investment. Boring, reliable infrastructure is often worth more than exceptional geology. It's not the sexiest lesson in mining economics, but it might be the most financially important one. Here's a trap that catches investors specifically during gold booms. When gold prices rise sharply, weak projects can start looking brilliant, simply because rising revenue masks underlying operational inefficiency. A mine that's poorly run, badly located, or structurally expensive to operate can still generate impressive-looking profit during a bull market, purely because the gold price is doing all the heavy lifting. This is exactly why so many mine acquisitions made during gold price booms end up looking far worse once the cycle inevitably turns and prices soften. A rising tide doesn't just lift good boats. In mining, it can hide genuinely bad ones until the tide goes back out. By now this should feel like a familiar pattern from everything else we've covered on this channel. The thing that kills a business often isn't the operational risk, it's the financing. Gold mines are extremely capital-intensive to build and operate, and leverage, meaning debt, can turn a genuinely promising project into a distress case the moment production disappoints or gold prices fall. In mining, the financing structure underneath a project can matter just as much as the quality of the actual ore body. A mine can have excellent gold, excellent grade, and excellent infrastructure, and still collapse, simply because it was financed too aggressively and couldn't survive one bad stretch of falling prices or delayed production. Here's a liability that sits quietly in the background for years, largely ignored until the mine's working life ends: environmental obligations. Mine closure, land reclamation, water treatment, and long-term environmental compliance can create real financial obligations that continue after production stops entirely. The cleanup bill isn't a footnote or an afterthought. It's genuinely part of the true, full cost of ownership, and a responsible valuation of any mine has to account for it from day one, not treat it as someone else's problem for later. Owners aren't just financing the mine's productive years. They're implicitly financing its eventual, expensive retirement too. Here's a nuance that flips the rich ore is best assumption from earlier in this video on its head, in a different direction. A mine with genuinely thin profit margins per ton of rock processed can still be an excellent business if it processes massive volumes efficiently. This is why some large, low-grade mining operations actually outperform smaller mines with more impressive-sounding ore grades. Scale changes the math entirely. A tiny margin, multiplied across an enormous volume can beat a large margin multiplied across a small one. This is also why gold mining investors are constantly weighing two completely different business models against each other, high-grade but small versus low-grade but massive, and why the best mine genuinely depends on which of those two games a company is actually built to play well. We touched on depletion earlier. Here's the strategic consequence of it. Gold mining is partly a reserve replacement race. An owner isn't just operating today's mine. They're constantly searching for tomorrow's mine, because companies that fail to replace their depleting reserves eventually become declining production stories, even if the current mine is still running perfectly well. Standing still in exploration means guaranteeing a shrinking company a few years down the road. This is why major gold mining companies spend enormous sums on exploration even while their current operations are profitable. It's not optional growth spending. It's survival spending disguised as growth. Here's the final distinction worth understanding clearly. Investors often value a gold mine very differently from how they value the metal itself. A gold mine is not the same asset as owning physical gold bullion. The mine carries operational risk, political risk, closure risk, and cost inflation risk, layers of risk that simply don't exist if you're holding gold directly. Which means a mining stock's valuation can move quite differently from the price of gold itself, even over the same period of time. This is exactly why gold miners often behave less like ordinary industrial companies and more like leveraged macro instruments, reacting to real interest rates, inflation expectations, currency debasement fears, and sovereign risk, layered on top of the underlying commodity price itself. So let's go back to where we started. Two mines, same gold, same ground, completely different outcomes. Now you know why. It was never really about how much gold was down there. It was about the ore grade, the stripping ratio, the currency exposure, the political stability of the country it sat in, the debt used to build it, and the discipline to keep replacing reserves before the current mine runs dry. That's why gold mine economics are such a clean window into the broader global system. Real interest rates, inflation fears, currency debasement, sovereign risk, and geopolitical stress all show up directly in whether a mine makes its owner wealthy or wipes them out. It's not really a mining business. It's a leveraged bet on the global economy wrapped in rock. If this changed the way you'll look at the next gold price headline, subscribe, because this channel exists to keep pulling apart the industries hiding behind the headlines. See you in the next one.